now get into the magical world of Disney. Because, you know, life is a fairy tale. Actually, not so true. And you know that life is not a fairy tale. Actually, today we'll tackle the story from a different angle. So now, before we start, my compliance officer in here is instructing me to read to you the following warning. So let's show that warning in here. So you may encounter notions or concepts you did not know existed or that are offered at Assumption Life. Assumption Life accepts no responsibility whatsoever for wanting to go the extra mile and to protect your clients more than you've been used to. Of course, I'm not kidding about going the extra mile, but I'm definitely kidding in here about this warning. So now that we could go on with the show, let's first tackle this by reviewing a brief history of life insurance as we know it. It started a long time ago, actually, with the Roman that initiated the burial club for soldiers, where upon death, they would all band together and pay for the expenses. Fast forward a few years in here, many years actually, and fast forward in England, and I'm of course thinking of the Lloyd's of London, where merchants and sailors actually would all organize themselves with some insurance deals to address marine and trading industries. Then successively in the US, churches and mutual also got together, organized themselves, developed solutions to protect their members. And of course, whatever was good in the US, well, it had to be good in Canada as well. So we saw in the mid-19th century, the first Canadian insurance company surface. I'm going to let you to guess which company that was in here. And over the years, we saw introduction of group programs and also a bunch of social program actually that took place. And that takes us to almost today. If we go back 40 years ago, actually in the early 80s, let's just click on this in here. So in the early 80s, we saw a wider use of computers in our industry, not just in our industry, actually, in our life in general. And with this came a number of tools that allowed professionals to better compare prices between the many carriers that are available. Now, comparing prices, not that price was not important before, actually, because price is important. But from that point on, from the early 90s, 80s to now, actually all eyes were on that metric. And for some, that became the only point of interest. Now, that brings us actually to something that we've heard a lot in the past 200 years. Actually, what we've heard from Mr. Benjamin Franklin, actually, we heard something like that. And in this world, nothing can be said to be certain except death and taxes. Now, that's a bad impression of Franklin in here, Benjamin Franklin, but that's what he had said actually the first time when he was a US ambassador in France. Now, what I would say, what we would say, it's more something like there's more to life than just death and the price. Now, there's something else that we hear a lot. We hear a term is a term is a term. What I say is that a term is a term, yes, but it doesn't have to stop there. And that's exactly where we're coming from here. Actually, at Assumption, we just don't want to stop there. So the first thing I'd like to address is actually extreme disability. So this is something that is brand new at Assumption Life. It's a built-in feature. And by built-in, I mean that it's not a rider. So you don't have to add it on. There's no cost attached to this in here. And you might be wondering, well, how does that work, that extreme disability feature? Well, if an insured is in a state of extreme disability, and I'll get to this in a moment. So if it's in a state of extreme disability for a period of 6 months before the age 60, we then pay half of the sum insured up to a maximum of 250,000. Now you're wondering, what does it take actually to be in a state of extreme disability? We often associate the lack of autonomy with old age, but the matter of fact is that you could lose autonomy at much younger age in here. You could lose autonomy if you get serious illness or if an accident strikes. In here, to qualify, the insured actually would have not to be able to perform 4 of the 6 activities of daily living. Activities of daily living, that's actually a measurement that's commonly used in gerontology. So here they are. The 6 activities of daily livings are bathing, toileting, feeding, dressing itself, moving around, or taking care of your business in the bathroom. And then you say, well, that's pretty extreme. And that's exactly why we call it that way. We call it extreme disability here. So it's extreme, yes, but, oh, not so fast here. Okay. But so the screen is acting on me here. It's extreme, but we're all exposed to this. It could even happen to Superman. Now, if we could get the screen in here, I'd like to see a picture of Christopher Reeve. So you remember Christopher Reeve? This handsome guy, healthy, great physical shape, and the one actually that wore the cape in the DC Comics character in the late 70s and 80s on the silver screen. Now, you may not remember this in here, but let me take you back. At the age of 42, he had a tragic horse riding accident, and that left him actually fully paralyzed from the neck down. Very tragic. That happened back in 1995. Now, I don't need to say more in here. That's extremely tragic. But interesting fact, though, is that Reeve actually died 10 years after the accident at age 52, out of cardiac arrest. Yes, extreme disability could even happen to Superman. Now, what Christopher Reeve got, actually, he suffered from this tragic horse riding accident. He basically had spinal cord injury. And let's move to the next one in here. And that could happen from all sorts of incidents. It mostly happened, as you see on the pie chart in here, it mostly happened in car accidents or when falling, or if you're a victim of an act of violence by gunshot, for instance. And to a lesser extent, it could also happen when doing sport, just like Christopher Reeve, or could happen on the operating table as well. Those accidents, those injuries actually happen at any age, but typically it happens with adults in the prime of their life. And as you could see on the slide here, median age of 35 years old. Half of the injury happened before age 35 and the other half after age 35. And as you could tell, and I don't know if it's testosterone actually that plays a part in here in perhaps taking more risk, but it occurs 4 times more frequently with men than women. Now, those are traumatic events in here, but it doesn't happen actually, it doesn't appear to affect marital status, interestingly enough. If you were single before the accident, you tend to remain single after. And the same could be said, actually, if you were married before, you actually stay married after. And all this in a proportion of 5 out of 6. Where it makes a difference is actually in the ability to remain employed. And as you could tell in here, it drops significantly when comparing before and after. Actually, 58% of the ones suffering from an injury were employed at the time of injury, and that drops to less than half, actually to 27% 10 years later. Now, an important fact, though, is the observation that you tend to live a good number of years after such injury. Actually, Actually, if you survive the first 24 hours after the injury, the majority, 81%, will actually live at least 10 years. Just like Christopher Reeve, that got his accident when he was 42 and eventually died at 52. Now, my question to you as financial advisor is, what sort of financial impact would that have actually with your clients? Now, I'm not necessarily looking for an answer in here, but I think you could figure it out. With events like that occurring, you would have the house to remodel, additional service that you would need, service of a nurse, for instance. There would be a significant drop of income. All of that would be extremely significant. Now, we've zeroed in, so financial impact would be significant. Now, we've zeroed in here with spinal cord injury, but remember that this could arise from illness as well. What your client should remember is that, you know what, this is life. Shit happens. And granted, that wouldn't happen very often, but when it does, I think you'll agree that this is very dramatic. Dramatic for the individual, but also for those surrounding him or her. Now, and third, it's a significant life-changing event on the personal side for sure, but clearly on the financial as well. Now, just don't take it from me in here. Actually, this feature is very well documented. Actually, it's right there, and it's right there in the contract. So that's for extreme disability. I'd like to change gears now, actually, and I'd like us to talk about guaranteed insurability benefit. That too is brand new on our flex term solution. And hey, as long as your client is less than 60-year-old and that it meets at least one qualifying event of the 6 qualifying events that are eligible in here, then your client has 2 months to obtain up to the lesser of 25% or 125,000 of extra coverage. And all this without any evidence of insurability. Is that easy? That easy for your client? That easy for you as the advisor? And the new benefit doesn't have to be a new flex term as well. Actually, it could be any underwritten solution at Assumption Life, whether it's permanent or term. And this is a built-in feature, actually, no additional cost, built-in. FYI, this is not a rider. So you're wondering what those qualifying events are. Well, there are 6, as I was mentioning. It could be a new loan, a mortgage, for instance, an increase in the sum borrowed for an existing loan. So let's say you buy a bigger home and you have to increase the mortgage on it. Well, that would qualify for this. You get married, that would qualify. You get divorced, that would qualify. You expand your family with more mouth to feed in here. Well, that would qualify as well. Or you get a degree, whether it's bachelor, master's, or PhD, that would qualify as well. So those are the 6 qualifying events that could be used actually to benefit from that guaranteed insurability. And these events will happen. Actually, we see a nice bunch of people in here on the slide. They will happen. If your clients, unless your clients live under a rock, if they are between the ages of 20 and 55, guaranteed that it will happen. And actually, whether they get a loan, as I was mentioning, or they could get divorced, yes, that would qualify. They could have babies, that would qualify. They could get a bigger mortgage, that would qualify. They could get married, that would qualify. And they could also graduate, as I was mentioning, and that would qualify. Now, not in that order in here. You've clearly recognized that this is not the usual order that we would see things happening, but it will happen. Actually, let me use my example in here. By the time I reach age 40, actually between the ages of 26 to 40, I had 5 of those qualifying events occurring to me. And some of them, actually 5, the only one I didn't get, thank God, is the divorce. So I had the other 5, and some of those events, actually, I got more than once. I bought a few houses in that period, and also had 2 kids. So 5 of those qualifying events for me, and some of them, a couple of them at least, a couple times. Now, just to reinforce, we've talked about marriage in here. Let's move just a little forward in here. So people still are getting married. Actually, more than half of the population between the ages of 25 to 64 are married. But as you could see here in the middle pie, actually people also split up. Nearly half of those walk away within 9 years. And we've talked about getting a loan, mortgage, and kids. Well, here in the third statistics, we get a bit of both in here. People that buy a home, buying a home means that kids are on the way. Actually, a third of first-time home buyer have kids in mind to have within the next 5 years. Now, we've talked about buying home. Let's talk about real estate. Actually, we hear about real estate almost every day now, and the real estate market is still going up. So let's move in here just briefly to the next slide. And it shows very little sign of slowing down. Although recently we do hear some sign of that slowing down, but the interest in buying homes is still there. What we see with those stats on the left in here is that the younger generation are still thinking of buying homes. And yes, that those stats could change from time to time, from 1 month to the next or 1 year to the next, but generally 1 in 5 to 1 in 7 of the Gen Z, millennials, and Gen X think of buying a home in the following year. Now, guaranteed insurability is really about celebrating happy events. Actually, for 5, let's move to the next slide. For 5 of the 6 qualifying events, like getting married, getting kids, getting a new home, graduating, those are all happy events. Actually, so 5 of the 6 in here are really happy events. And actually, some individual might even argue that divorcing is also a happy event. So during those active period of your client, actually, those events will happen for sure. Just like it did for me over the course of 14 years, where I had actually 5 of those qualifying events. Now, the advisor in here has an opportunity to play a part in those in helping those clients actually in those good times, and with good times come also increased responsibility, and that's really what guaranteed insurability is all about. Now, just like I showed you a bit earlier in here, all of this, it's not just words in a presentation, it's actually all in the contract, very well displayed in section H actually of our flex term contract. Now let's talk about join first to die in our flex term. Now, the survivor, and what we saw on this slide in here is pretty basic, so I'll go very quickly. Actually, with flex term, the survivor remains insured for 45 days following the first death. Of course, a conversion could be done in those 45 days in here to a permanent during that period. And at any point in time, actually, the two could decide to split the policy in 2 using the same date of issue. All of this is pretty basic. And actually, we see some advisors tend not to like join first to die solutions in here. But we're here to show you how we made it better with some of the features actually that would make it more interesting for you. So let's move to the next one in here, where it gets really interesting and flexible is in a situation of legal separation or divorce. I was just talking about divorce in here in the previous section, but in this case here, if there's a legal separation or a divorce where both insured are actually less than 60-year-old, each of the two could go separate ways with the full amount, the full insured amount, not half as we usually see, but the full amount, 100%. And the premiums, bonus in here, the premiums are calculated just as it was originally issued. That's great, and that's very different from what we see in the market. So let's see a few stats in here about more statistics about divorce, just for fun here. Look at this. Actually, 42% get divorced after their first marriage. And of those that remarry, because many would remarry, actually 60% would untie the knot. And for those that still didn't get the message after 2 divorces in here and still decide to remarry yet again, well, 3 out of 4 would decide to go separate ways. Well, I think you'll get the message in here. But for those divorcing after the first marriage, actually they stayed together an average of only 8 years. So you see how this joint first to die provision in here could really help out in here should there be a divorce occurring, and that could happen, you know, reasonably fast. Now, I'd like to share a few statistics that just came out just recently in here. We're still in a pandemic, as we can all appreciate, but it looks like this pandemic did something good. It did at least one thing good in here. For couples, actually, it got couples to appreciate their partners way more actually than before. As you see in here, 58% of married couples admitted that COVID-19 made them appreciate their partner more. Now, I don't know if, and also looking by the stats of the number of divorces that have come down, I don't know, that may have had something to do that they had more problem getting in front of a judge. But you know, that remains to be seen. Nevertheless, you see that the numbers did come down in 2020, still very close to 43,000 of divorce that took place, which, you know what, even if it came down, there's still a huge number in here. And remember, our joint first to die provision in here, just not addressing splitting the policies in 2 in cases of divorce, but it's also for legal separation as well. Now, we're just not saying this in here. Actually, let me give you a few takeaways in here. People do split up, and they do split up a lot, you could tell. And actually, the need for insurance actually doesn't go away when people are splitting up. And that's why we've put together that provision to really help out in those hard times. Now, we're just not saying this in here. Again, those joint first to die provision are shown and very clearly spelled out in here in our contract. Now, people are often at the last minute. I don't think that would be a surprise to anyone in here. In some cases, that's okay. You know, an individual might want to keep their options open. That's all right. Others might just don't think much about anything, and they deal with the situation as it comes up, and that's fine too. But finally, others just choose to procrastinate. Actually, they don't choose, they just procrastinate. As simple as that. And what we've done in here to address this, actually, we've adjusted 2 provisions that we've had to give more time for the advisor and its client. Whether they procrastinate or they don't. What we've done first, we've extended the period to convert to a permanent product to now go right up to age 75. It used to be 70, it's now 75. The second thing that we've done is that following the initial term, whether it's 10 years, 15, 20 years, it will now revert into YRT. So unless you're dying or sleeping at the wheel, you know very well that very few insured actually would normally renew for another 10 years, 15, 20 years. Either you let your coverage go and you don't need it anymore, or you convert, or you just reapply actually to get more reasonable terms. But the thing is that if you still need the coverage, that period right after, if you procrastinated or if you just took a little time, actually that extra time at a lower cost using YRT will actually help you, the advisor, and your client actually to get better terms in here and to do the right thing at the right time. So let's talk a little bit more about procrastination in here, just for fun. Actually, it's not getting any better. Actually, in the last 40 years, it has increased fivefold. It used to be that chronic procrastinator, they used to be about 5%, 1 in 20. It's now 26%. So I don't know what happened here. But really where the financial advisor comes into play is that a lot of procrastinators are actually losing money. Actually, a good number of them, 20%, for 20%, it gets really, really bad. They're playing with fire with their job. They're throwing away their credit rating. Their relationships are going bad. We talked about divorce a bit earlier in here. And their health is also having an impact on their health. So not very good. Now, those buying time provision, as I like to call them, is just another way actually to mitigate procrastination. Now, you know, like me, it doesn't pay to procrastinate. And of course, the sooner the better. Now, I'm not just saying this in here. Again, you see it all in our contract. It's all very well spelled out. Now, let's change gears in here. I've mentioned Benjamin Franklin a little bit earlier, that was saying that there's nothing that can be said to be certain except death and taxes. But you all know that there's more to life than just that. Actually, there's CI, there's DI, and there's also a bunch of riders actually that could also be considered. And we'll show you in here how overemphasizing on the risk of dying alone actually might not be very wise. So let's take an example in here. I've got Jack and Jill. Let's see Jack and Jill. Jack and Jill, they're both 35 and they're both non-smokers. Now, the probability of becoming disabled by the time they reach 65, so 30 years between 35 to 65, is way more significant, actually, of the probability to get critically ill or dying during that 30-year period. Actually, the risk of dying, as you could see in here, is a mere 4 or 6% over that 30-year period. And when you factor all three factors together, and not just by adding up, because there would be joint factors in here coming into play, but when you factor in the risk of becoming disabled, becoming critically ill, or dying in that 30-year period, actually it's 51 and 52%. Now let's stick with Jack and Jill, but let's make them smokers this time. And here we are. So 30. Of course, I don't want them to smoke, but you know what I mean in here. Let's make them smokers for this example. So let's show the stats in here. So in here, comparing with the previous one that we've seen, the major difference is actually with the risk of dying over that 30-year period. Actually, that went up threefold. And the combined risk of something occurring, becoming disabled, critically ill, or dying is actually 54% for both Jack and Jill in this case. I'll do a couple more cases actually at 45 this time. Let's look at Jack and Jill, just 10 years older, and let's make them non-smokers again. In here, actually with less time, so there's 20 years to age 65 in this case. So instead of the 30 years that we were seeing just a bit earlier, so with less time to age 65, the probability reduces on all three risks with an overall risk, a combined risk actually of 46%, as you could tell. Let's move to, for our last example, let's make them smokers this time and just end, long story short, now that they're smokers, 20 years to go to 65, well, we're talking about a combined risk of 49 and 48%. So there's a common denominator in the four examples that we've seen in here. Let's move to the next slide and thinking mortgage market in here. So people that are between the ages of 35 to 45, I would actually extend that from 30 to 50 in this case. It doesn't matter if you're 35, 40, or 45. It doesn't matter if you smoke or you don't smoke. It doesn't matter if your name is Jack or Jill. Actually, you've noticed the combined risk actually is all around 50%. You've seen the 51%, 52, 54, 46, 49. It's all around 50%. So the probability of becoming disabled, critically ill, or dying is about 50% in all of those cases. So it's a 1 in 2 chance, and 1 in 2 chance. So it's like flipping the coin here. Only selling life insurance is a bit of a disservice to a client. If your client's need is actually pretty high on life insurance, but they have a very limited budget, you may be better off actually to scale down on the life insurance, just as we've seen with the stats in here, with the risk of becoming disabled or critically ill. You might be better off to scale down on the life insurance to get, to keep some budget money to buy DI and CI coverage as well. By the way, we've just increased our CI to 50,000 actually without any additional question on our flex term. So just a little bonus in here to keep in mind. So mitigating risk in here is no small affair. Actually, it's a work of art. And, work of art, I'm thinking avoiding risk for the trio of life, DI, and CI. So that's what I had actually to just showcase our new flex term. So basically do the right thing in here, take a look, and as far as I'm concerned, this is the best value for the money currently in the market. So without further ado, I'd like to pass the mic in here to Youssef to address our simplified issues solution.
Thank you, Daniel. Very, very dynamic presentation. So Youssef Lahlou, I'm here to present the simplified issue solutions at Assumption Life. But before getting there, let's see and talk a little bit about what's this market. It's actually been here for many years, but still not very well known. Just to go back again on some statistics, 45% of people aged from 45 to 64 years old don't own life insurance yet. And we will go a little bit further on those statistics. And 47 of clients of 65 and older don't own life insurance. And 27, they only have group insurance solutions. And most of the times what happens is that we might have at our younger ages term products solutions, or we might have some group insurance solutions that might end sometimes. And going to convert that isn't, as Danielle mentioned earlier, a thing that we do, we might procrastinate, etc. And sometimes the transformation or the conversion solutions aren't that interesting or very expensive. So with this graphic here, what we see exactly is half of our Canadian citizens don't have life insurance. And on the other half, only 26% have both group and individual insurance. Only 25% have individual insurance, which means at the very end that there is a very large clientele out there of clients older of the age of 45, that don't have any solutions. And the other thing is, as we are getting older, some medical or non-medical conditions can come up and make things even a little bit harder for clients to get insured. So here what we have is 90% of clients over 50 suffer from chronic illnesses. When we talk about chronic illnesses, it's not just a heart attack or cancer, can be also diabetes, high pressure, cholesterol, and 80% of them suffer from multiple symptoms. So then as a client, or let's say as a broker, you do have two solutions. Going with the usual underwritten solutions on which we will go and ask for an APS. It will take a week or two, a month, 3, if we have to go to the archives and get the information from the hospital. In this period of pandemic, it can take multiple months before having a decision, and the client might even be refused, deferred, or he might be rated because of those multiple symptoms or conditions. So, and the other solution, on the other hand, would be the simplified issue solutions. Some very simple questions on which the client have to answer, and he will get his application accepted within 24 hours. So this is actually the outcome of the Simplify. Either wait multiple months, be rated or deferred, or have actually a look on the simplified issue solutions, get insured right away. And you as a broker, you've insured your client, you can move on to the next client. So let's see our market here in Canada. The underlying clients with underlying health conditions for clients over 50 represents more than 57.8%. And this is the market that Assumption Life has targeted on our simplified issue solutions. So on that, we wanted to be as inclusive as possible, as competitive on pricing, and being able, and I will repeat that a couple of times, to ensure immediately clients that might be deferred elsewhere. So why Assumption Life? Assumption Life, actually, we have more than 25 years of experience in the simplified issue solutions. This gave us time to understand the markets, understand the risks, and also to have unified questionnaires and to be actually more able to take some specific risks that others are not able to. The other thing is that we have the widest range of immediate coverages, and we will see that in the upcoming slides. And finally, we are the only insurer that can insure clients up to the age of 85. Yes, 85. So those are our solutions. We are going from bronze for people actually who are in very bad condition. And we can say that there are no questions that we are asking. Are you breathing? Yes. Okay, we can insure you. So this is the bronze solution, and we can move up to the platinum one, which actually is a solution on which 75% of clients who come to Assumption Life can qualify with. And the main reason is how our questions have been made and how inclusive they are. So this is the list of quite all the medical or non-medical condition that we're able to insure with our simplified issue solution. And as I mentioned earlier, I'm gonna say it again and again, we have immediate solutions for clients who are deferred elsewhere with the other careers. Let's take a couple examples here. Let's take the example of diabetes, type 1 diabetes. Actually, we don't ask question if the client has type 1 or type 2 diabetes. We don't ask question about at what age he was diagnosed with that. We don't ask questions about if he changed or if he has new medication for diabetes. The only thing that we're gonna ask about diabetes is, does the client have diabetes? Yes. Does he have any additional, and there's a multiple of very severe conditions that the client had in the past. So it's a combination of many very hard conditions with diabetes. Otherwise, if you have a type 1 client, type 1 diabetes client who is 20 years old, let's say, you might be qualified with our best solution, which is platinum. Same thing for, let's say, sleep apnea. Even if it's recently diagnosed, we have no question about sleep apnea on our application. Overweight, we have among the most liberal height and weights chart in the industry right now in our application. Cancer, if the client had more than one cancer in the past, we'll be able to give him some very good solutions. Same thing for depression, anxiety, or burnout. We don't ask any question about that. If the client is in let's say depression leave right now, and he needs a life insurance, our simplified issue solution will be able to cover him. We have no COVID question, no question about 1 day surgery on hold. Let's say the client will have surgery on his knee, and he's been on the list for many months, and it can take him years now with what's happening. So yes, we can insure him. Same thing, we are able to insure people who are in a wheelchair or with some handicaps. So let's check exactly how we do among the other careers on the market. So here, let's meet Jack. Jack is 45-year-old. He's a non-smoker. He's overall in good health, but he's a little bit rough. So 5'10", 270, he might qualify for our, actually even better than this, I should actually correct this slide. He might even qualify for the platinum solution in this case. But still, what I wanted to explain in this slide is, even with quite the same premium, yes, we do have a very competitive premium in this case, but what is important is that he will be covered immediately. What does it mean? It means that if he dies naturally or because of an illness or anything within the next 2 years, we will pay the full face amount. When you're deferred, most of the time, what happens if you die, not accidentally, but because of a medical condition or naturally, the carriers will reimburse the premium plus a percentage. In our case, with the deferred products, we're reimbursing with 3% of that. So imagine actually how important to focus on this immediate compared to deferred. In those cases, we're talking about people who already have some underlying health conditions, which means that their risk to die before others who are healthy is bigger, which means that the immediate actually solution will take much more importance in this case. We have another example of Rachel, 50-year-old smoker. She has hepatitis C 5 years ago, and she's still on treatment. So she might qualify for our Golden Protection Elites. And same here, she will be immediate with Assumption Life as she might be deferred with the other careers. One unique advantage that we offer at Assumption Life is being able to cover in one and same contract healthy people with underwritten solution like Flex Term that Danielle presented earlier, with Simplified issue solution, both together on the same contract. So you have to do only one application, one follow-up eventually, even though sometimes it can go really, really fast. So one application very fast, the client will have just one contract. So here is the example of Rosy and Carlos. So Carlos is in excellent health, he's 40 years old, and Rosy had cancer 6 years ago. And she recovered since then, and Rosy would qualify because of her cancer to our Simplified Platinum Protection. But because of what Rosy went through, Carlos is now open to talk about the 3 conditions that Danielle mentioned earlier, and having the balanced solution on which you have CI, DI, and life insurance together to cover up all the risks that he might go through. And actually, with what happened to Rosy, they understand that it's now very, very important to be well covered on both life, DI, and CI. So in this example here, we can combine Carlos protections, so those are underwritten protections, with those of Rosy, which is a simplified issue, all together in one contract, and still compare to multiple contracts with the best premiums on the markets that can actually come and cover those risks. Rosy would be deferred. We are immediate, and the premium is quite the same, but we'll still can say that we are quite competitive. And this is how it looks like on the illustration, being able to have underwritten products and simplified issue solutions all together in one application. And the next one will be John. John is 70-year-old. He has type 2 diabetes. He had a bypass surgery 6 years ago. He would qualify for platinum protection. But John actually doesn't want to go with the whole life, because usually at those ages, there is no carrier on the market that offers term solutions for people up to the age of 70. So in this case, his budget doesn't allow him to go with the whole life. And on the other hand, he has a need of $50,000. You can still give him the option to be covered with the term solution with Assumption Life, either a T10 or a T20. In this case, we have a term 20, 50,000, and we are the only carrier on the market offering term solutions in the simplified issue products solutions on the market at those ages. And let's go to our last example. Big Daddy, he's 82 years old. Type 2 diabetes, bypass surgery 5 years ago, overweight. He needs some final expense. He has a final expense needs. We understand that nobody would actually insure this client if you go with the underwritten solutions. And we are the only carrier on the market offering solutions for people up to the age of 85. So yeah, we have actually at Assumption Life a tool, and you can scan for those who have their phones on their hands right now. You can scan up the QR code that can lead you to our simplified selection tool. This will help you actually qualify your client, specifically when you have the client have multiple medical or non-medical conditions, and you would like to know to what product they will qualify with. And it will even give you an idea of the pricing and the different solutions, term or whole life or 20-pay whole life solutions are actually available for those clients. Just to summarize a little bit, the two presentations actually that we had this afternoon, and we're very happy to have you with us, guys, is that with the market that we're working on those days, the added value that you're bringing to your clients, either on the underwriting or simplified issue solutions, will make a big difference. As Danielle mentioned earlier, we're actually led to go and check on the premium and check on the cheapest premium on the market as the first thing to do as a broker, because we're a broker. A broker is there to find the best solution at the cheapest price. But you are there to find the best solution too. So looking on what each coverage Assumption Life has been working on and all the added value that we've included can bring you to the next step as an advisor that looks at things other than the premiums. With the added value rather than commodities, we are increasing the value of your advisor, provide better context for the clients, puts the client's needs at the center of the solution, and not as easily replaceable. I'm telling you, when you have a contract with added values, with multiple protections, where, as Danielle mentioned earlier, it's very, very hard to be replaced. And the other thing is, the beauty of the thing is that our premium, even on our Flexum, with all the added values that we've just actually launched this January, we are still very competitive price-wise. So in conclusion, life is not a fairy tale, but with all the risks we are exposed to, an advisor could help his client with a solution ensuring the story ends better. So the flex term give you the flexibility to adapt to your client's situations in the future. They are buying a new house, it's a couple, they are having kids, things are going well, so the coverage is doing its job. They get separated because of the separation, the life insurance need might increase because of that. And one of them, because of the separation, let's say that he goes on depression, what happens? He will not be able to get insured easily with the traditional and written solutions. So the insurability benefits will help. On the other hand, the extreme disability benefit will help in case of, let's say, an accident that leaves the clients not able to do 4 of the 6 usual daily activities. And finally, the option of joint first die. We are here on a market where the clients are looking for the cheapest premium. You know, the prices of houses, if we talk about the mortgage insurance, have been increasing like crazy during the last 2 years, which makes them actually have their budget down because of their mortgage payments. So they might look for cheaper solutions. But as Danielle mentioned earlier, going with the joint first to die, yes, it's cheaper, but usually on the other careers, the joint first to die doesn't give much advantages in case of separation of divorce. So with the joint first to die, being able to separate the contract with 100% of coverage for both at the moments of separation of divorce, and also the premium at the dates of issue gives you quite the same actually options as a multi-life contract, but with the cheapest premium.
We started the presentation by stating that we wanted to go the extra mile, but at the end of the day, what we're doing is that we're putting in your hands the opportunity to go and go the extra mile in here with your client, and that's really what counts in this case. And I was indicating earlier the best value for the money. You've seen some price comparison actually with Youssef on the simplified issue. You really get to have your cake and eat it too in here. So definitely something to worth taking a look at assumption in here and just going beyond the commodity game and just give more to your client for the same money. So we're gonna thank IDC. Thanks IDC actually for putting that together. Very appreciative for that. Thanks for the one that attended in here. Thanks for your support and thanks for taking a look at assumption in here and for the added value. Thanks a lot.
Thank you very much, guys. Have a great day.